3M continues to fall down 20% over the last year. In fact, just over the last week, down 3%, and over the last month, down 14%. So is this a very big worry? Should we be looking to sell 3M? Or is now a fantastic opportunity to buy this undervalued company, where we have analysts believing that 3M could possibly double over the next 5 years? We also have talks today around a dividend increase, which they increased by 0.7%. Very, very mediocre. We also want to cover some insider selling that has happened over the last few days, and we want to go into some more detail about what we now understand with the lawsuits that have been in place, which are looking to be settled, and see whether or not a massive dividend cut is coming for 3M. As always, we will analyze the company, their top line, their bottom line revenue over the last few years. We now have the December 2023 annual report results. We'll also see how well the balance sheet is, their total cash versus total debt after these lawsuits, which are expected to be paid out. And we'll also see whether or not this is an industry-wide issue or whether this is isolated purely to 3M over their performance. And we'll also look to the institutions to see if they are continuing to buy shares of 3M, and we'll discuss this dividend safety. It does look to be unsafe, so are there some real concerns about whether or not we should be anticipating a very large cut? And don't forget, with all this new information, we will run it again through the intrinsic value calculator to get to the acceptable buy price given our investor margin of safety, and see whether or not Wall Street still see this as a buy now. So let's jump very quickly then into their historical performance. Now, they have been down on any aspect that you look. Year to date, just a few months, down 16.5%. Yes, it doesn't include dividends reinvested. Nonetheless, we can see very poor performance, down 30% over the last 10 years, with their all-time highs around $259. Again, trading towards the 52-week low with a yield of 6.5%, and we can see a forward PE just under 10. So let's get into the main point that we want to discuss in today's episode, whether or not we see 3M being able to be doubled in the next 5 years and what exactly it would take. Now, this article that has come from the Motley Fool, one of the things that really brought my attention that I want to point out today is talking about the future, especially with those lawsuits that are expected to be settled and the amount given the free cash flow. So one of the things that I want to point out, I want to run these numbers through to make it very clear the issues that we are facing with these lawsuits and the amount of free cash flow versus the dividends generated for this company. So having moved these numbers across, what exactly this is saying is that 3M every single year, they have around $5 billion worth of free cash flow, as we can see here. Now, the lawsuit for the earplugs is expected to cost them around $6 billion, which is expected to be spread to 2029. So roughly $1 billion over the next 5 to 6 years. So we have that $1 billion minus amount here in red. The chemical lawsuit expected to cost them $12.5 billion over the next 13 years. So approximately $1 billion less from their annual free cash flow every year, which means their dividends of $3.3 billion is also a point where they have to pay out every single year, and they have increased that, which we will talk about, which means once we do the additions and subtractions, they start off with $5 billion, less $1 billion, we get $4 billion, less another billion, $3 billion. Now, less the dividends that they pay out means they are left with negative $300 million on that free cash flow, which is a bit of a worry, and again, something we should think about. Now, let's find out why they expect this share price to double over the next 10 years, or 5 years in fact. Now, the majority of what they do discuss in this article talks about how they are expecting and guiding for flat to 2% revenue growth this year, so that things have started to stabilize. However, the consensus by the analysts, who are very optimistic, are expecting earnings to grow between 3 or in fact 4 to 7% annually over the next few years. And what they also hope is that we do see potentially a dividend cut, so that essentially their free cash flow is a lot healthier, or in fact a smaller dividend to free up the cash flow. So there is a lot riding on their dividend being a lot smaller, whether that's through a small increase that we're about to discuss, or whether or not that is essentially through a cut of the dividend. So let's firstly take a look that I want to draw your attention to, something that we just spotted just a few days ago with some insider selling. Now, It is important to note that insider selling isn't necessarily a bearish signal. Management sell for many reasons, whether that's personal or financial. But what we found is that the group president, Chavez Rodriguez, has sold around 426 shares. Now, it isn't a massive amount, especially for them, around 40,000. But it is important just to note this was something that happened just a few days ago, so we thought to bring it to your attention. And we can see since then it is down around 1 to 2% from their sale point. It isn't something that I would say to take into massive consideration, but as always, we do want to be transparent. Now let's take a look at the institutions. Well, we've already noted 65% institutional ownership, and we can see that even though 5 billion worth of shares have been sold over the last 12 months, the institutions have still been buying 3M shares, and we can see in the most recent quarter, right here, Q4, 2.1 billion worth of shares bought versus 958 million. So the institutions clearly believe this is a winning stock for the future. But as always, it is important to note, always do your own due diligence on any of the stocks that we do cover on this channel, and never follow blindly what the institutions are doing. Now, very quickly, just want to point out when we analyze their top line revenue growth, we can see from 32 billion in 2019, it hasn't moved to their latest annual report from December 2023. So their top line is flat. Even on a more granular level, we see no movement from 2019 to 2020. We see around a 10% increase to 2021 before a drop in 2022 and 2023. Now, management are forecasting between 0 to 2% growth over the next few years. So something just to bear that in mind in your investment thesis. Remember, as we always say, if a company's not getting at least 3 to 7%, they're not really keeping up in line with inflation. On the bottom line as well, we can see they've gone from a 4.5 billion net profit in 2019 to a negative 7 billion loss in 2023. And again, on a more granular level, we see it increase to 2021 before decreasing those next 2 years. So a lot of things just to consider as we are running through here, and we will wrap up and conclude towards the end. But it is important just to note these within your own investment thesis. Now, quick health check, total cash versus total debt. Their cash position has more than doubled from 2.4 billion in 2019 to 6 billion in their latest report from just last week. Then when we compare this numerically and directionally, we can see that 3M's total debt has in fact decreased, which is a good sign, from 21 billion to 17 billion. So positive to note, their cash actually has increased while their total debt has decreased. So there is some positive things to note here. Now, just very quickly, for those that are new, to compare it to the industrial conglomerates competitors, we have Hitachi, we also have a few others. Now look, over the last year, including dividends reinvested, 3M is one of the worst performing. Now we can see, however, there are one or two that throughout the industry have made a positive return over the period. So you could argue it is an issue that is isolated to 3M. And in fact, the majority of this share price that has been annihilated are through those numbers that we just ran with those lawsuits really suppressing their free cash flow. In terms of 3M, well, they're also the worst performing over the last 5 years. And we can see around only one, in fact, which is HDHI, is a positive performer at a very strong rate. You do have two, however, they aren't the greatest return over a 5-year period. So always bear that in mind, and also understand that past performance isn't an indicator of the future. Just because 3M has performed negatively over the last 5 years or even the last 10 years, it isn't to say they won't perform much stronger over the future periods. So let's take a look at their dividend safety. Let's try and understand why we're seeing a very unsafe score of 40. Now, market cap 50 billion, it is a large cap company. In terms of those recessionary metrics, well, they increased the dividend during the last recession. They had above average growth, or around average growth, in fact, negative 13%. And they had a pretty much inline recession return, negative 54% versus the S&P's negative 55%. Dividend growth, as I mentioned, they did increase the dividend, yay. But then when we take a look at it, 0.7%, absolutely incredibly poor. You may as well have not got a dividend increase. I think that was around a 1 cent increase. They were probably better off keeping that and putting it towards paying off these lawsuits and settlements. Over the last 5 years, 2%. Over the last 20 years, yes, 8%. It is good to note, but when we look at the more recent period, it is very poor and below that 4% inflationary target we advocate on the channel. Now look, they are a dividend king. They have increased the dividend for the last 50 years, so we do understand they do want to keep that up while very, very minimally increasing the dividend payout. And they have, over the last 108 years, paid a dividend without a reduction. Now, in terms of dividend yield theory, yes, it states a company is undervalued when the current yield sits above the 5-year average. So we have a sign of undervaluation on the yield, as well as the forward PE 9.5 below the 5-year average. But this is why we always say we never conclude on any of these models in isolation, as there are a lot of other information to factor in before jumping into a company. We can also see the sector PE for industrials are much higher at 19.7. Now, very important to note the free cash flow payout. As always, we do focus on that as the earnings is susceptible to manipulation by management through accounting. 60%, my blanket rule, I want to see below that because it gives me faith management are able to offer those double-digit dividends we love to see. Now look, 2023, the latest year, 66% isn't actually that bad, but no surprise given their dividend increase was by 1 cent, around 0.7%. 2024 expected to be around the same. Free cash flow per share, again, always have realistic expectations depending on the industry you're looking to invest in, but 791 to 914, very minimal growth and very, very inconsistent year on year. In fact, 2024 we can see that is expected to be not too far off the current year's figures. Sales growth, again, a big hit to the top line. Both the last 2 years, as we ran through, we discussed that 10% increase. But over the last 10 years, most of the years, in fact, half of the years have been negative growth. So again, just bear that in mind with 3M. And when we look at the sales figures, it's gone from 32 billion to around 33 billion. So when you factor in inflation in real terms, the top line has been decreasing. Now look, they also do share buybacks. They have returned excess cash to investors and they have reduced it from 662 million to 554 over the last 10 years. ROIC now is one of my 7 golden dividend metrics. I want to see 10% or more. This gives me faith that management are able to effectively allocate their capital. And it's nice to note in 2023 it was strong at 26%. And over the longer term it has been very, very strong. Now in terms of the margins, very positive to note, maybe surprisingly actually, that they have had some strong margins, above 12% consistently over the last 10 years. Quite strong in 2023, the latest annual report at 18%, and the same can be said for the free cash flow margin, so actually quite positive when just looking at the margin aspect. Now the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, typically tells us 2 things. Now one, the balance sheet strength, and 2, the dividend safety. Now what we're looking for here is below 3 for the majority of companies, with these being the number of years it would take the company to pay off all of their debt net of cash on hand. 1.33 in 2023, 1.24 in 2024. So actually it looks pretty decent, along with that payout ratio around 60 to 70%. You would be wondering, why is that dividend looking to be unsafe? Now the reason for that, as we mentioned at the beginning of the episode, we can see that free cash flow, which is being hammered by 1, the large amount of dividend in relation to the free cash flow, and 2, those 2 lawsuits which are expected to take up some portion of their free cash flow. When you combine all of that together, it leaves them with a negative free cash flow. So you need to ask yourself whether or not 3M are going to be able to increase their free cash flow and that top line. Otherwise, they could start to be in real trouble over the next few years, and a dividend cut could be the biggest solution to helping reduce that very quickly. Now, before we jump into the valuation, just to let you know, we have released today our latest free weekly newsletter edition, running through share buybacks, why they're important. We also have other articles running through insider buying and selling, companies which are undervalued with strong upside, as well as running through our 7 golden dividend metrics to identify undervalued companies. Completely free. If you want to sign up, just click on that pinned comment below and you can have access straight away to all of these articles. So let's jump into the valuation of 3M. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically we run through all 4 of these models, and we can do today, but very quickly, just to let you know, the first model is essentially irrelevant given the fact that their earnings per share over the trailing 12 months is negative. That also makes the second model irrelevant, coupled with the fact that there aren't any companies that I would say are similar to use them as the multiples valuation. So we move on to the dividend discount model. Now we have some incredibly mediocre dividend increases. Average growth rate of 1%. Now forward looking, in all honesty, I have been pretty optimistic here at 1.7%. I would like to see this come back to the company, but this really depends on whether or not they are going to be able to increase their free cash flow over the next few years. I do have hope that they will be able to, but it won't be as easy, and there is a bit of a risk involved. Intrinsic value, then we get a sign of undervaluation, although very marginally, but do bear in mind we're not looking at any of these models in isolation. We then have the DCF model where we have the free cash flow year on year. We have the average growth rate around 1%. We've pretty much gone in line with that. Pretty conservative given analysts do have a much higher target. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see here, another undervaluation signal. So essentially the intrinsic value is just the average of these two models, and don't forget you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment below. Margin of safety then, we typically start off with 10%, which we use if we believe the company has a wide moat, a strong financial metrics and good forward-looking data. We can pretty much see 3M is around $1 shy, so we pretty much see around a 10% margin of safety currently with 3M. Now, there are a ton of risks that we ran through, with the most important one being their free cash flow. They're going to need to increase this over the longer term, especially to pay off not just that very large amount of dividends, but also the fact of those two lawsuits, which will be big trouble if they are unable to, as that means a dividend cut, as I mentioned earlier, will be the easiest solution. Now, personally, I think that they should do a dividend cut. It will, in fact, help the investors as well, as it will reduce a lot of this debt and liability that they do face, and they can put that money towards helping the company grow and some of that towards paying the settlement as well, rather than having this big pressure and just increasing the dividend very, very marginally year on year for absolutely no reason. Now, in terms of the Wall Street and their forecast, they see a price target of $106 over the next 12 months. They see upside of 16%. Now, those who are looking to add 3M at different rates, at a 15% margin of safety, acceptable buy would be $85, at 20% around $80.41, and at 25% around $75. All I would say is never say never. Just because you see $75, it doesn't necessarily mean it won't ever hit. You never know what will happen. One, if they're unable to pay the dividend, or two, we see a dividend cut. But I'm going to conclude here by saying there are a lot of risks. You could also argue there is some reward here to be had. This could be a value play to turn around over the next few years. Now, me personally, this is one that I do hold currently. It isn't one I'm going to be adding to just yet. The only issue I have now is whether or not they are going to be able to continue pay not just the dividend, but also the settlement over the next few years. There is a lot to wait and see with 3M. As always, let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, see you on the next episode and take care for now.